Steve Liesman has more on the silver lining over Main Street's economy.
The International Monetary Fund marked down the global economy Tuesday, mostly a result of lower oil prices hitting growth in emerging markets. But what it didn't do was mark up the advanced economies or growth among consumers of those cheaper commodities. For the U.S. consumer, cheaper oil prices have meant lower inflation and increased buying power. Data to be released by the government tomorrow should show that real or inflation-adjusted wages for average workers in 2015 had their best year since the recession ended. The consumers also benefited from strong job growth and decent home price appreciation, leading to brighter views on the economy among the public. But while the IMF slashed its 2016 forecast for oil-soaked economies like Russia and Saudi Arabia, it also downgraded the U.S. by 0.2 to 2.6% from 2.8%. And the IMF chief economist even said that he thinks markets are overlooking the silver lining from the decline in oil prices.
There are still positive effects on consumers and on companies that rely on energy for their production processes and are benefiting from lower production costs.
Market pros caution against mixing up the U.S. economy and U.S. financial markets. They're separate, they say.
The U.S. economy in a global setting is unique. It's the most closed economy, meaning it's the least dependent on the rest of the world. The rest of the world means less for the U.S. economy than the U.S. economy means for the rest of the world. But when it comes to financial markets, the financial market linkages are much greater. The U.S. financial market sensitivity to external events.
That means worries about China and oil prices can and probably should bring down U.S. stock prices, and they have. But it's not entirely clear that should mean a markdown in U.S. growth or worries about recession. At least since the Great Recession, these are some of the best times for the U.S. consumer. For Nightly Business Report, I'm Steve Liesman.